Yeah, some really interesting data came out this week from CoreLogic that I wanted to touch on. And as Ross said, there's a lot of noise out there at the moment in regards to what's happening in the market. So I found this really interesting, just breaking down what segment of the market is moving, what segment of the market is moving backwards, where are things up to truly when you're looking at the numbers. So I did touch on this last time. It's basically properties that are broken up into 10 segments, from the cheapest being number one to the most expensive being in the 10th decile there. And what this is showing is properties in the lower end of the market. This is the national list, but properties at the lower end have actually had some reasonable growth in the last 12 months. The blue is the last 12 months and the black is the last quarter. So there's actually been some reasonable results across the lower end of the market over the last 12 months. The major dips we've really seen at the higher end of the market, with 6.2% drop in that 10th percentile band. So it's the high end that seems to be dipping. So it's just interesting that the high end seems to be the one that's falling off the most, as opposed to the lower end of the market. And when you look at the lower end, it's only the 9th and 10th percentiles that have actually dropped by more than 2% over the last 12 months. So the rest of the market's actually holding up quite well. Sydney, if you look at Sydney, realistically the middle is holding up okay, but it is the higher end that is dropping in Sydney. We all know that. If you look at Melbourne, the lower end, I guess if you just go back and say, if you were to buy in Sydney, where would you aim? Well, you'd aim the lower end, obviously. You'd try and buy at the lower end if you're buying in Sydney at the moment. Is that what you would suggest, Paul? If you're going to look in Sydney at the moment, you'd be looking towards the lower end of the market?
Yeah, I spoke to Munzerl only a couple of days ago.
Yeah.
Some ex-government housing that went to auction only last week, and I think there was some properties within Campbelltown to Edenvale, etc., that were selling in that $360,000 to $410,000 price point for 3-bedroom, 600 square metre properties.
Yes.
There's some definite value there.
Yeah, so value, if you can find something at the cheaper end in Sydney, that's where you would be looking. Obviously, higher end in Sydney, much harder to find some value. When they're talking about the 10th percentile in Sydney, they're talking about $2 million plus properties is that band. Over the 9th is about $1.5 million. So it's the higher end properties that we've really seen the big drop in. And that could be a capacity issue as well. So the ability to borrow funds, the banks tightening the screws, and the affordability of people is what's pushing those higher end properties down further and faster than the middle range properties. But you even look at the last quarter, even getting down to this middle range, the last quarter has been quite disappointing for those Sydney properties as well. Melbourne, same sort of story, but the last 12 months has been quite strong at that lower end of the market in Melbourne. Small drops in the last quarter, but the last year has actually been quite strong at that lower end in Melbourne. So again, if you're looking in Melbourne, I would be suggesting looking at the lower end where there's some opportunities, as opposed to the higher end, which is actually just picking up steam in terms of how much it's dropping in the last quarter. It's actually starting to accelerate in its decline. So Melbourne, if you're looking for opportunities in Melbourne, certainly look towards that lower end of the property market there. Brisbane, chugging along. The graph looks good, but it's actually 1.9 is the highest percent there. So just chugging along without doing too much at all. But at least it's positive. I think that's the thing that I take out of this. At least it is going in a positive direction. Again, the low end of the market here, as opposed to Sydney and Melbourne, the lower end really hasn't done a lot in the last quarter. It's the middle properties that have actually seen some reasonable growth in the last quarter in Brisbane, that if that keeps up, that'll give us 4% next year, 4 or 5%. So at least Brisbane seems like it's winding up in the right direction growth-wise, which is great. High end, not quite as well, but the more expensive properties are holding up quite well in Brisbane compared to the Sydney and the Melbourne markets at that high end. I just wanted to pop this one in. This is it's like an upside down graph compared to the last ones that we've been looking at, and it's the Perth values. So the lower end has dropped off more in Perth than the higher end. So I think this is probably a reflection on what the mining boom busting has done to the market there in Perth. It's actually had more of an impact on the lower end, the workers, the unemployment lifting has had a worse effect on the cheaper properties, as opposed to the big end of town. It has actually had growth in the last 12 months in Perth. So those with money still have money and are still buying, and those properties are still going up in Perth, but it's that lower end to middle that seems to be running off harder. The actual decrease in property values in Perth from the peak, they've come off about 20%, 19-20% from peak in Perth. So there's some talk that it's bottoming out, but if you look at the last quarter, it's still quite a drop in values in the last quarter. So, Paul, your thoughts on hitting the bottom of the Perth market? Doesn't look like we're there yet.
Yeah, no, it's a good point. I think what that translates to is a lot of the interstate migration issues and a lot of the investor stock that came probably on the market and is now the stuff that's not really getting picked up because there is no demand in that $200,000 to $500,000 price point. They're still struggling to find demand. Vacancy rates sitting above probably 6, 7, 8%. Yeah. And it's really those owner occupiers, the ones who didn't exit out when the market and the economy started to turn. They're still there, they're still earning good money, and those properties are still much more in demand, where that graph reflects.
So these properties were built with the mind that you've got all the fly in, fly out rentals.
You've got more domestic people moving in to try and take advantage of an economy that was booming, which now is not the case, and there's too much supply still within that market.
And you've got your nice owner-occupied homes down this end where people are still happy to buy and live. Yeah, right. Exactly. Interesting. Hobart has been a real achiever for the last couple of years, and we've seen great growth annually, lower end right up to the top end, with a combined 11.5% growth over the last 12 months. The last quarter, however, has been coming off, basically. So, I mean, I look at this graph and in my mind, I'm thinking if you're not in if you're not in Hobart now, you've missed it, I think, is what this graph's sort of saying. Agree with that? Yep. Paul's nodding away, yep.
5 months.
5 months, just missed it. But interesting, but great for Hobart that it's performed so well. But really looking elsewhere to invest right now, I think. Canberra's an interesting one. I mean, Canberra's just full of public servants, so that middle ground property is what they're looking for in Canberra, and it's actually interesting just to see in the last quarter almost a 2% drop at the very bottom end in Canberra. So whether that's a starting point for seeing that flow on a little bit more over the next couple of quarters, over the next 6 months, a bit of a drop in Canberra, you might start to see that. But it has performed quite well over the last 12 months. But the last quarter seems like Canberra might be turning there as well. Paul, your thoughts on Canberra?
Yeah, I think you've probably seen the restrictions there from an investor perspective. Land tax at the lower end is an issue, and I think at the higher end you're going to see consistency. But coming up to an election, now. When you start to see the public servant sector and the housing sector start to become a little bit wavy, and you look at it tracking every federal election, you start to see really similar graphs, because
who's moving in, who's
moving
moving
out, and who's a bit trepid. Well, there's a bit of trepidation about job security for the next government who's coming in, and you start to see that people don't necessarily go out and want to upgrade or buy that investment property, even if they live in Canberra at that time as well.
Very good. But that's some slides on where the market is segment by segment, because we say a lot that there's markets within markets, and it's trying to say, well, where do I pick where to buy? And I like this type of data because it says, okay, well, Sydney, if you're buying, buy low. In Melbourne, if you're buying, buy cheap. If you're buying in Brisbane, buy middle of the road properties, don't particularly buy cheap. If you're buying in Canberra, look at those middle of the road type properties. If you're buying, it was interesting in Perth. If you're buying, buy expensive. Go somewhere an owner occupied would like to live. So you've got to take the data for what it is, but also try and take away what you can in regards to where should I be buying within market segments.